All right, so here we are with the first video of our different types of adjustments. Deferred expenses. Now, deferred expenses are, to kind of put it in a definition format, these are assets paid in advance of receiving their benefits. I paid for these up front, but I haven't used them yet, so I can't expense them yet until the very end. A great example of this would be those stamps that I talked about. I purchased those stamps up front, and then as I use them, and again, exaggerated example, but if I buy a book of stamps and I use one stamp and put it on an envelope and then send it off, I've used that one stamp, and theoretically, I could expense that one stamp. But why would I expense that one stamp when I'm going to use them for the rest of the year? So what I'll do is I'll wait till the very end of the year, add up all the stamps that I used, and just do one big entry at the very end. And it makes things a little bit easier. I don't have to keep up with every individual time I use them. Once the asset has been used, the advance payments become expenses. So I convert them over from assets to expenses. That's why these are called deferred expenses. So let's look at an example of this. And this is, again, going back to Chapter 2's example video where we did the entire journal entries and T-tables and stuff like that. We're just going to add on to this. This is December 31st of that year. So please follow along. We're still using the Bravo Company example. So it says, of the $24,000 of prepaid rent Bravo Company paid on April 1st, again, that was an example from the last one, it has used $18,000. So pretty much what we did is we said, we're going to prepay $24,000 up front for rent. And then over time, we're going to start using that rent. Month after month, we're going to use it. But instead of doing a journal entry that says we're going to take it out of prepaid rent and put it into rent expense every single month, we'll just do what we did for the entire year. We'll add them all up, defer that expense until the very end, and then just do one big journal entry. And so let's look at first how we get this calculation. This is actually one that they don't have to give you because you have everything you need in order to do the calculation. So let's look at the calculation here. This is beside calculation. I already know right away that I've used $18,000 of the $24,000 that I put in prepaid. That's fine. If they use it, you don't have to do this. But I do want to show you how you would do this calculation. So first you would start with the amount that you prepaid. We paid $24,000 in prepaid rent for this year. And it started on April 1st. Now we need to multiply this by the number of months that we've actually used. Remember, we expense things that we've used. Now we started on April 1st, and this is for 1 year or 12 months. We haven't used 12 months. We've only used from April to December 31st. So we need to count up those months. If you count up those months, that's going to give me, well, there you go, number of months between the start date and December 31st. If we count that up, that's going to give me 9 months. So, and you do have to count April because it is April 1st. So all of April. So April, May, June, July, August, September, October, November, December, 9 months. Okay. We're going to divide that by the total number of months of this prepayment, which was, again, we said 12 months. So again, this is going to be the number of, our total number of months paid for, 12 months. And so if we do that calculation, that's going to give us the $18,000 that we have. That's where that number comes from. So if it's not given to you, you know how to calculate it now. But now that we know it, it's going to be 18,000. Let's actually do a journal entry for it. So here's what we have right now. This is not anything different than what you had in Chapter 2. This is what we ended Chapter 2 with. So now we're just going to continue adding on journal entries to the bottom. I want to move the page up a little bit. And I'm going to add in our first journal entry. So again, we're taking it out of prepaid. So we'll say December 31st, we have prepaid rent, or excuse me, rent expense, because I'm expensing it. That's our debit. And then $18,000, because that's what we have. And I'm going to take it out of prepaid rent. And so I'm going to debit prepaid, or excuse me, credit prepaid rent. And so when I do that, that's going to give me the journal entry. I'm going to go ahead and put these into our T-tables. I need to add T-tables for it. So it's going to be $18,000 on the debit side for rent expense. I'm also going to put in $18,000 on the credit side for prepaid rent. That is our journal entry for this one. Now that's one type of deferred expense. We have another type of deferred expense, and I alluded to this earlier in this video, which is the supplies. So let's look at the supplies. It says, after a physical count of supplies was conducted, it was found that Bravo Company had $350 still available to use. So I started with a sum, I added some more, and then by the end of it, after I used all of these, I have $350,000 still that I can use for the next year. So that's really my ending balance. So we got to figure out how many did we use, because that's what we need to use to expense things. What we use, we expense. So let's do the calculations for this. This is our supplies T-table that you should have already. Now what we're saying by this is that we're saying my ending balance is $350. So if I put ending balance $350 there, I'm really saying what do I need to credit supplies by in order to make this T-table true? Remember, debits and credits, if you subtract the two, that's going to give me my ending balance. So what is it going to be? Well, if I add 400 to 1500, that's giving me 1900. And then if I subtract out, here's the side calculation. So I'm going to start with my beginning balance of 400. I'm going to add to it my 1500 that I purchased. So any additions that I have. So 1500. That's going to tell me that I have 1900 available to use at that time. And if I subtract out my ending balance of 350, that's going to give me what I actually did use. And that's the amount consumed, or it's going to be 1550. So that's what I would need to credit my supplies account with. So now that I know how much I actually used, now I can do the journal entry. So let's go back to our example. I'm going to add another line. So we have, again, 1231. I'm going to do supplies expense, because again, this is what I'm expensing, 1550. And then I'm going to debit supplies because I've lost that in supplies by 1550. And again, put these into my T-tables, supplies expense. There's a new T-table for that. And then already I have the 1550 in my supplies T-table on the credit side. So again, we're able to push these back because, yes, I did use the supplies over the course of the year, but remember the matching principle. The matching principle states that I have to make sure that I expense it in the period in which I used them. So it doesn't matter if I use them over the course of 7 months. As long as I have them expensed by December 31st of that year, they're still within that period. And so that's why we're able to do these adjustments. So these are just two. The next 3 videos, we're going to talk about some more. So hopefully that made sense to you. Appreciate it.